We're going to get started. To those of you who just logged in, welcome again to Kleinberg Kaplan's webinar on insurance dedicated funds. My name is Max Carpel. I'm a corporate partner at Kleinberg Kaplan, and I'll be moderating this event. And I'm joined by my tax partners, Jeff Bordnick and Phil Gross. Jeff is a tax partner at Kleinberg Kaplan. He's been with the firm for 30 years. He's written extensively on today's topic, including having written or co-written many articles and a chapter in the book, The PPLI Solution. Over the past 20 years, he's given tax advice to hedge funds, to investors, to policyholders, insurance brokers, and insurance companies about insurance-dedicated funds and life insurance invested in hedge funds. My partner, Phil Gross, has been with Kleinberg Kaplan for 20 years. His focus is on the taxation of hedge funds. He's a frequent speaker and an author on tax issues faced by hedge funds, and he recently spoke at a seminar in D.C. on the taxation of private placement life insurance. I've been with Kleinberg for 9 years, and I work on structuring and forming funds, hedge funds, and that includes insurance-dedicated funds. And I also represent hedge funds doing transactional work, including negotiating and documenting public and private investment deals. Please feel free to ask questions by typing them in the questions box. We're going to answer the questions at the end. And if we don't get to your questions, please contact us. Our contact information is in the presentation, and we'll send you a copy of the presentation in the coming days. Recently, we've seen a spike of interest in insurance-dedicated funds. That's been reflected, among other things, in the interest we've seen in today's seminar. During this webinar, you'll hear about what is an insurance-dedicated fund, why do we think there's been more interest in this product recently, what kind of benefits are there for a hedge fund manager and for investors in IDFs, what type of hedge fund manager should consider setting up an insurance-dedicated fund, and what goes into setting one up, and what are the tax and securities law issues and requirements involved. And also, what kind of issues do hedge fund managers face in setting up insurance-dedicated funds? And as I mentioned, we're also going to take questions during, well, you can type in your questions during the webinar, and we'll answer them at the end. Kleinberg Kaplan is a leader in representing hedge fund managers in structuring and launching insurance-dedicated funds. Insurance-dedicated funds have the potential to allow investors to eliminate income tax on investment earnings, and with proper estate planning, to eliminate estate tax as well. So let's dive right in. Jeff, if you could tell us, what is an insurance-dedicated fund?
An insurance-dedicated fund is a hedge fund open only to one or more insurance companies. The insurance companies issue life insurance policies or annuities to U.S. taxable investors and invest the premiums received from the investors into the IDF. The policyholder effectively earns the investment returns of the hedge fund less insurance-related costs, with potentially significant tax savings and other potential benefits.
Thanks, Jeff. We'll go into some more background in a little bit, but Phil, can you tell us, why do you think we're seeing so much interest now in insurance-dedicated funds?
Max, one of the biggest tax issues that we are facing today is that we have significantly higher income tax rates than we have had in many years, and there have been proposals that would even further increase effective tax rates. For example, the tax rate on long-term capital gains and qualified dividend income has increased from 15% in 2012 to 25% in 2013, for a 66% increase. And the tax rate on other income has increased from either 35% or about 38% to about 45%. These rates take into account Social Security and the new 3.8% Medicare contribution tax, which some of you may know as the net investment income tax. And these rates also take into account the 3% phase out of certain itemized deductions, which had ceased to be effective in 2010, but is now back in effect. These rates do not take into account state and city tax rates, however, and For example, if you are a resident in New York City or California, your effective tax rate can be 55% or more. We believe these significantly higher tax rates are causing taxpayers to pay more attention to their taxes and consider ways to reduce their taxes. The ability to reduce taxes through life insurance or an annuity presents an opportunity to attract and retain capital to a hedge fund manager that offers an idea.
Thanks, Phil. Now let's briefly discuss the history. Kleinberg Kaplan has been a pioneer in the field of private placement life insurance for over 25 years. Jeff, if you could please give us some background on private placement life insurance and insurance-dedicated funds, that would be great.
Over 25 years ago, one of our clients, who is a hedge fund manager, told us that his business was doing great, but the returns of his hedge fund were so good that the taxes due on the income was becoming a real problem. He asked us to come up with a way for his hedge fund earnings not to be subject to income taxation. This sounded like an impossible goal. To our surprise, after considering several alternatives, we realized this goal might be achieved through single premium whole life insurance invested in his hedge fund. At the time, tax rates were relatively low and were decreasing, and using insurance had numerous complications, not the least of which was finding an insurance company that would invest in his hedge fund rather than manage the money themselves. So the client decided to defer this project. However, by 1991, it looked like tax rates were heading up, and we started looking at variable life insurance with cash value invested in a hedge fund more seriously. We sometimes refer to this as hedge fund life insurance. Today, with certain restrictions, this long sought-after policy is available to wealthy individuals from some insurance companies, and many such life insurance policies and annuities have been issued. Our firm has represented hedge fund managers setting up insurance-dedicated funds, investors who have bought hedge fund insurance policies, and insurance brokers selling these policies. The good news for hedge fund managers who set up an IDF is that the hedge fund investment choices available to investors who wish to take advantage of the tax benefits of private placement life insurance are generally limited to hedge fund managers who have set up so-called insurance-dedicated funds.
Thanks, Jeff. Phil, with that background, could you tell us what type of hedge fund managers should consider offering an IDF?
Actually, all hedge fund managers should consider it, but particularly hedge fund managers with tax-inefficient returns. The Internal Revenue Code taxes different types of income and investment returns very differently, as previously mentioned. For example, long-term capital gains and qualified dividends are generally taxed at much lower rates than interest income and short-term capital gains. Another example is a hedge fund that is considered an investor in securities for tax purposes, as opposed to being considered a trader. Individual investors in funds, which are considered to be investors in securities, may lose some or all of the tax benefits deducting many deductions. Investors in hedge funds which produce mostly short-term capital gains or ordinary income, or which are considered investors in securities, may be most interested in investing in such fund strategies through insurance-dedicated funds. So fund managers managing such funds should definitely consider setting up IDFs.
Thanks, Phil. I'm now going to describe how these funds are structured. Insurance-dedicated funds are generally structured as standalone U.S. domestic hedge funds. As you can see on the chart that's now on your screen, there's the insurance company, which issues a life insurance policy, for example, to the policy owner, and then through its separate account invests into the hedge fund, which is a Delaware limited partnership with a general partner and an investment manager. The main difference between an IDF and a typical U.S. domestic hedge fund is that an IDF may generally only be offered to insurance companies, or as you can see on the chart, to the separate account of the insurance company. As mentioned, we typically set up an insurance dedicated fund as a Delaware limited partnership and take advantage of the exemption from registration provided by Section 3C7 of the Investment Company Act of 1940. The hedge fund manager may have an existing entity that could serve as the general partner, or it may want to, for liability reasons, set up a new entity to serve as a GP. The impetus for forming an insurance dedicated fund often comes from a hedge fund's existing investors who want the tax benefits of private placement life insurance. Hedge fund managers may set up an insurance dedicated fund that's similar to an existing fund that they manage. The fund may have similar terms to other funds that the hedge fund manager manages, but the insurance company will require special liquidity provisions to address the fact that the insurance company will eventually have to pay death benefits. In particular, the need to pay death benefits will override any lockup or gate, which makes sense given the life insurance feature. For tax reasons, an IDF generally needs to have an investment strategy which is at least slightly different than other funds that the hedge fund manager is managing. For example, the IDF may have more or less leverage or more or less concentration of positions than a similar existing fund. Now, Jeff, what are some of the key features of private placement life insurance that the folks on the call today should be aware of?
Private placement life insurance is life insurance with a separately invested account for that policy's cash value, which may be invested in a hedge fund IDF. The pure insurance portion is essentially low-cost life insurance, which allows the entire investment to qualify for tax purposes as life insurance. The costs of setting up and maintaining the policy are charged to the account, and the account grows or shrinks depending on the success of the insurance dedicated fund. The life insurance is placed on someone's life, the insured, and at that person's death, the policy pays to the beneficiary the amount of the pure term insurance then in place, plus the cash value invested in the IDF. The entire death benefit, including all the earnings from the IDF, is received by the beneficiary free of all income taxes.
Phil, what happens if a policy owner wants to surrender the policy early?
If the owner needs cash and therefore wants to surrender the policy before the death of the insured, the income is generally taxed at that time at an ordinary rate plus an excise tax of 10% of the gain if the owner is less than 59.5. Alternatively, if a policy owner wants to access cash under certain policies, that is, policies which are called non-modified endowment contracts or non-MEC, as long as the policy is not terminated, a substantial portion of the cash value may be borrowed against as a loan, income tax-free.
Thanks, Phil. Jeff, how do insurance dedicated funds generate income tax savings for policy owners?
Placing the investment within a life insurance policy eliminates current taxation, and the payment of the appreciation through a death benefit is income tax-free. Therefore, the appreciation can be free of all income taxes. Within such a framework, a tax-inefficient investment can become a tax-efficient one. As an example, as previously mentioned, a New York City resident may pay approximately 55% tax on the total returns of an inefficient hedge fund investment, so that a 12% per annum return may become a 5.4% after-tax return. Instead of taxes reducing the return from 12% to 5.4%, the reduced internal rate of return under the insurance policy invested in an IDF with the same 12% investment return should be around 11% after taking into account policy costs of about 1%, thereby increasing the after-tax internal rate of return from 5.4% per annum to around 11%. The tax benefits are greater the higher the assumed investment return, the higher the tax rate, and the longer the number of years of compounding. The potential benefit of an 11% IRR as compared with a 5.4% IRR over a large period of time is enormous.
So Phil, the other way that there can be tax savings is on the estate tax side. How do insurance dedicated funds create savings from an estate tax perspective?
Max, a key element of effective estate planning is to make gifts of assets in trust so that the assets in the trust will not be subject to estate tax. Private placement life insurance is a particularly good asset for estate planning since it pays a large death benefit and grows income tax-free at the rate of the return of the underlying hedge fund or hedge fund. Private placement life insurance policies are often purchased by life insurance trusts so that the death benefit is both income tax-free, as Jeff just went through, and estate tax-free, since the assets of the trust are not considered to be assets of the decedent. It is important to have the life insurance trust purchase the private placement life insurance policy rather than to have the individual purchase the policy and then contribute the policy to the life insurance trust. If the individual purchases the policy and then contributes it to the trust, and if the individual dies within 3 years of contributing to the trust, the policy proceeds are subject to estate tax. If the trust buys the policy, however, there's no 3-year rule, and the insurance proceeds are not included in the estate of the decedent and are not subject to estate tax. Sometimes the issue will come up regarding how can a trust have enough money to pay premiums on the life insurance policy. There are several ways to get money into a trust to enable the trust to have sufficient money to purchase a policy. Some of the ways are the use of an existing trust, the use of the annual and lifetime gift tax exemptions, and the use of loans to the trust.
Thanks, Phil. Jeff, what are private placement variable annuities, and why would an investor buy an annuity invested in an insurance-dedicated fund?
Max, private placement variable annuities are similar to private placement life insurance, but do not provide a sufficient death benefit to be considered life insurance for U.S. income tax purposes. Annuities defer, but do not eliminate U.S. income tax. The tax benefits of annuities from tax deferral are less than the tax benefits of life insurance paid as a death benefit, tax elimination. But if the deferral is for a long enough period of time and at a high enough rate of return, it can be worthwhile. Hedge fund annuities are cheaper, quicker, and less complex than life insurance, and are often considered by investors for whom life insurance is not appropriate, such as someone who is not insurable or insurable only at high cost, someone who does not want to undergo insurance underwriting and medical exams, or who wants to invest so much in the product that the insurer cannot write enough life insurance. That is, the amount exceeds the insurer's capacity. Appreciation on annuities is generally taxed as ordinary income when received and subject to a 10% penalty for withdrawals received prior to age 59.5.
Thanks, Jeff. Now we've discussed the basic features of the insurance tax savings and of private placement life insurance and of the annuity possibility. And now from the fund perspective, Jeff, if you could talk a little bit about the main issues that an insurance-dedicated fund must address to maintain its tax-free feature, that would be great.
Sure, Max. The main tax requirements are diversification and investor control. To achieve the potentially substantial tax benefits, the cash value of the policy must be adequately diversified, and the policyholder must have only limited control over how the cash value is invested. The diversification requirement can generally be met if you establish an insurance-dedicated fund that invests no more than 55% of the value of its assets in any one investment, no more than 70% of the value of its assets in any two investments, no more than 80% of the value of its assets in any three investments, and no more than 90% of the value of its assets in any four investments. You can look through the insurance-dedicated fund at its underlying investments to determine whether the diversification requirement has been met. You cannot look through a fund that is not an insurance-dedicated fund. A policy invested 100% in a single hedge fund that is not an insurance-dedicated fund would be considered invested in one investment and fail the diversification requirement. Because of the look-through for insurance-dedicated funds, IDFs generally can easily meet the diversification requirement. The other major tax concern is investor control. There is a risk that if the policyholder has too much control over how the policy is invested, the IRS would consider the policyholder, as opposed to the insurance company, to be the owner of the assets for tax purposes. This issue can generally be addressed if you limit direct communication between the hedge fund manager and the insurance policy holder.
On the subject of investor control, the most difficult issue that some hedge fund managers face in setting up an IDF is getting comfortable with the ability to meet the insurance company's requirements with respect to investor control. This isn't because hedge fund managers would give investment control over to the policy owner. In fact, most hedge fund managers don't accept investment direction or even advice necessarily from their investors. But they often do have open communication with their investors, and that's something that could be viewed by the insurance company as risky, in the sense that the communications between the policy owner and the hedge fund manager could be characterized by the IRS as a violation of the investor control doctrine. This is an especially sensitive issue in situations where the insurance company's policy owners are also investors in other funds managed by the hedge fund manager, and the hedge fund manager wants to continue normal communications with its existing investors. To address this, we've worked with our hedge fund clients and with the insurance companies to develop procedures that mitigate the risk that investor control could be deemed to exist, and to make sure that the documents for the fund allocate the risk of any liability that could arise in a fair way among the parties. The next thing we'll talk about is documentation. What types of documentation are involved in setting up an insurance-dedicated fund? In terms of documentation, there's a private placement memorandum that contains disclosure about the fund strategy. Now keep in mind that the fund is only open to insurance companies, so the audience for the PPM is the insurance companies, and the insurance companies will provide their own disclosure materials to policy owners, which may include the PPM under the insurance company's own wrapper. Each insurance company that invests in the fund is generally going to ask the fund, the investment advisor, and the general partner to enter into a participation agreement, which governs the terms of the insurance company's subscriptions and their investment in the fund. Each insurance company, on behalf of its separate accounts, is going to want to know that the interests in the fund are going to be made available to it, that the insurance company can withdraw funds when it needs to pay death benefits and to pay expenses, and that the hedge fund manager is going to assume a certain level of responsibility for complying with the diversification requirement and the investor control procedures that Jeff was discussing a moment ago. There's also going to be a limited partnership agreement for the fund, since it's a limited partnership. And there's going to be an investment management agreement between the fund and the hedge fund manager. So Phil, now that we've covered the basic tax structure and documentation issues involved in an insurance dedicated fund, let me ask you the question that was asked at the very beginning, which is, will launching an insurance dedicated fund help hedge fund managers attract and retain capital?
Max, the short answer is yes, we believe it will. The number of IDFs remains relatively small compared with the number of hedge funds that exist. That's why there can be a competitive advantage to a hedge fund manager that sets up an IDF. There are a number of ways that an IDF could attract and retain capital. First, policy owners are not subject to current taxation on the fund's earnings and therefore do not need to withdraw capital to pay taxes, so more money will remain in an IDF. Second, by increasing after-tax returns, an insurance dedicated fund is potentially a much more attractive investment than a taxable hedge fund, and therefore can attract investors that might not otherwise have invested in the fund, or such investors might invest more money in the fund. Third, the potential tax disadvantage of withdrawing money from a policy early may make insurance money invested in an insurance dedicated fund more sticky and less likely to be withdrawn from the fund. Last, policyholders have more limited hedge fund choices than taxable investors, and therefore this may make it more likely that they leave the money in the IDF.
Thank you, Phil. We're now going to take questions. There's been a number of questions that are already sent to us. Some of them are substantive questions, and some of them are questions about getting additional copies and things like that. So why don't we just start going through those. The first question is, are you going to email a copy of the presentation subsequently? And the answer is yes. We are going to send a copy of the slideshow presentation out to everybody who registered and everybody who's on the call today. The next question is, do you need a tax opinion? And I'll direct that question to Jeff.
The short answer is no. You don't need a tax opinion.
The next question is, can we get a copy of the slideshow? Well, that one we answered already as well. Will we be able to re-listen to this presentation? Our plan is to rebroadcast the presentation, and we will send out details on that. Another question that we have is, what are the benefits and drawbacks of simply purchasing IDFs on behalf of the insured person versus setting up an IDF internally? I'll direct that question to Jeff.
I'm not sure I understand the question. Can you repeat it?
So the question is I guess really the question is it possible to purchase really private placement life insurance and then invest it into a regular fund? I guess this maybe assumes that it's not that there isn't an insurance dedicated fund. Why not do it that way?
Yeah, the issue is if you did that, it would not follow the diversification requirement if the fund is open. It needs to go into an IDF. In fact, from an investor's point of view, what they are doing is they are buying a policy, and their choices are limited to IDFs or other choices that the insurance company has decided upon.
Yeah, I think otherwise you could potentially, but you'd have to invest in at least the five hedge funds meeting the diversification requirements just by looking at the hedge funds. So.
The next question is, can you use an LLC for the IDF? Does it matter?
Yeah. You probably can use an LLC, but because the tax regulations use the term partnership, and out of caution, most people use partnerships.
Another question that's come up is an IDF necessary, or can this be done with an allocator model? I heard there was IRS guidance against the allocator model, but I don't see how it's different from an IDF if investment decisions are truly independent.
I think it's possible to do through an allocator model, but an allocator model is basically the same as an IDF, but you just don't have a partnership. You have someone making a decision what type of investments to go into. There are many IDFs that are funds of funds.
I think that's correct. I think traditionally there were more fund of funds, and that were the IDFs, and they'd invest in other funds sometimes. And now what we're seeing is more single IDFs rather than two funds of funds.
Another question is, how much interaction is permissible with investors once they're invested? That's one part of the question. The other part is, how much interaction is permitted before they're invested?
There's no specific answer to that question. The investor control requirement is a very vague requirement and more of a risk than an actual stated requirement. So any discussions increase that risk.
One thing that's worth mentioning, though, is that given the fact that insurance products are involved, it's generally from a regulatory standpoint a good idea to leave the sale of the insurance policy to the insurance brokers. There's still some more questions, so we'll try to keep up with them as they're coming in. They're actually coming in with a high frequency right now. One question that's come up now is there tax shelter registration, and is it challengeable by the IRS?
Okay, I don't believe there's any tax shelter registration. This is known by the IRS. They have issued guidance related to it. I think the issues that we have discussed are the ways that they could potentially attack it. There's a statutory provision for diversification. As I indicated, diversification is generally fairly easy for a hedge fund to meet. You only need about 5 investments. I actually don't know any hedge funds that don't meet the diversification requirements, as long as they set up as an IDF and that they're limited to insurance companies.
Here's another question that just came up. Can the insurance company change hedge fund managers if performance is poor without triggering early withdrawal penalties?
The answer is yes, and to some extent have to. The insurance company is responsible for who they choose as the potential investments. And therefore, if a fund were to do very poorly, the insurance company would probably choose other choices and other IDFs.
And at no time, though, does the money come out of the insurance policy. It's still in the insurance policy. It's just where it's invested, it changes.
Yes, and most of the insurance companies actually offer a number of choices. So if someone wants to move from an IDF that they're invested in into another one, they generally can do that. There is also a tax-free exchange that's allowed to a different insurance policy. So generally, there would not be a tax-free withdrawal just because someone wants to change the investment, or taxable withdrawal, I should say.
Another question we have is, has the IRS audited any IDF structures and policies? And if they did, what was the rule? Was the ruling favorable?
As far as I know, the IRS has not audited anyone. They have issued rulings, some related to this, so they've issued some guidance. The investor control requirement came in prior to the diversification law, which was put into effect in 1984, I believe. And since it became law, there's been no challenge, as far as I know, from the IRS of any types of these private placement, variable insurance or annuities.
There were some issues about PPLI and taxation, maybe the late 90s and even earlier than that, even into the 2000s, but regulations and guidance issued in 2003 and 2005, I think, really say this is really just a life insurance policy. It has to meet these rules, and if it's not taxable, if it meets these rules. So there's still some issues you have to be careful of, as we discussed in our presentation, but and we're not aware of an audit. We believe there's about 70 or 80 IDFs out there, but we are not aware of an audit.
Another question that's come up is, can the investor redeem from an existing fund and go into an IDF?
The answer is yes. There's probably slightly more investor control concerns in doing that, but the answer is yes.
Another question is, can you speak a little more about specific risks to the investor?
I'm not sure what nature of
what would happen if it fails,
okay.
if they're in there and it fails.
Yes, the tax risk is that the investor is considered to be taxed the same way as if they were invested in a hedge fund, which means that they would be subject to current taxation.
I mean, is there any concern, let's say, that if that happens 10 years later, that there'd be penalties? Or
there's always the possibility of interest and penalties. There is also the possibility, if it happens 10 years later, that somebody has been closed by the statute of limitations.
So I mean, would you characterize that as a high risk or a low risk?
Well, I think that the risk of this not working is a very low risk to begin with.
Mm-hmm. Here's another question that's come up. Do any of us know how much assets are in IDF hedge funds? I think we saw a number. We saw a number recently that was.
I've been told that at least $2 billion.
Yeah,
some amount of billions.
But not much on a relative basis compared to what's in hedge funds generally.
And I think our understanding is that that's viewed as a benefit, because to the extent somebody's interested in investing in this manner, the policy owner and the insurance companies have relatively limited choices. I think it's one of the things that Phil mentioned as a factor that might make insurance dedicated funds attractive to managers, because if you do set one up, there's not that many others on a relative basis at this point who've also done so. Here's another question. If one were only interested in annuity money, would they still have to accommodate the death benefit payout, which seems like it would not apply to an annuity?
The death benefits don't apply to annuities.
So we've seen funds that maybe are only open to annuities?
We have not seen one, but I guess that's technically possible, but we have not seen that.
Is the SMA a bankruptcy remote vehicle? So if the life insurance company goes under, the policyholder's investment is secure?
The answer is yes, and we probably should mention that asset protection is one of the reasons that people buy these insurance policies.
Yeah, it's protected from both claims against the life insurance company in general and also claims against the insured are also protected against.
Another question is, how difficult is it to elect the charitable donation option?
There is some of that out there as far as the class or other things, but those I think are a little bit too complicated to get into with not too much time left.
I mean, in general, to the extent there's questions that we haven't answered or that you want us to follow up on, definitely feel free to contact us. Our contact information is in the back of the presentation, which we are going to send around, as we mentioned. We'll take a couple of more questions. Is there an offshore version of the IDF for offshore carriers, or can one IDF structure fit both onshore and offshore?
One structure can be both for onshore and offshore.
I'm just putting up the contact information now, even though we're not yet at the end of the seminar, so that you can, if you do have questions that you want more information about, you can take that down. It will take us at least a day to send out the presentation to everybody on the call. We still have a few more minutes, so we might as well take the questions that are out there. One question is, how long does it take to set up an IDF? So setting up an IDF is very similar, as we mentioned, to setting up a domestic hedge fund, but you layer into that the process of entering into the agreement with the insurance company or coming to terms with them. So, I mean, it could take anywhere from a month, but I would say typically it would take about 2 to 6 months to set it up. It could take a little bit longer, depending on how many issues arise in the context of putting it together. Another question is, okay, I want to set up an IDF. What do I do? So we'd be happy to sit down and talk to you about whatever you're interested in doing in terms of next steps. The first step would be to discuss the terms of your funds and the arrangements that would be made with the life insurance company. In our experience, it's often a good idea to start with a term sheet and make sure that you're on the same page as the insurance company in terms of the fund, in terms of liquidity, the terms, and in terms of whether and how you're going to comply with the requirements such as diversification and investor control. We would then negotiate the agreement with the insurance company, prepare the PPM and the other documents that I mentioned earlier. So the process is something that we're familiar with and would be happy to help with. Okay, there's still a few more questions coming up. How many insurance companies are actively marketing these policies? Are they the well-known companies or smaller insurance companies? So there's a number of companies that market it, and they work with insurance brokers to market it.
And there are several that are more in this than others, but we don't know the number that actually out there. But there's a couple of well-known ones.
There's definitely some that have done much more of this than others. Another question is, who can invest in an insurance dedicated fund?
Well, the insurance dedicated fund is technically only open to insurance companies, but anyone could buy a policy where the cash value is invested in the insurance dedicated fund, either in life insurance or an annuity. Generally, because of the tax advantages, is one of the reasons people buy it. It's generally U.S. taxable investors that invest in these policies.
From a securities law and hedge fund law standpoint, they're typically offered as 3C7 funds. So the investors have to be accredited and they have to be qualified purchasers. But it could also be structured as a 3C1 fund. But from a practical standpoint, that would be unusual because of the types of investors who'd be interested in it. They usually are going to be highly qualified, and so in general, we rely on 3C7 as for the Company Act exemption. There's still more questions, but we're actually running out of time. So please contact us with your questions. Our contact information is on the screen. Thank you for participating in today's Kleinberg Kaplan webinar. We hope you found it informative and helpful. We believe that this is the time for insurance dedicated funds with rising tax rates. We have over 25 years of experience with this type of product, which is unique in the industry, really. We put significant effort and resources into this product, and we can help you if you're a hedge fund manager interested in setting up an insurance dedicated fund, or if you have an existing insurance dedicated fund, or if you are an individual interested in these products. As I mentioned at the beginning, please contact us directly with any questions that you have, and once again, we'll be sending you copies of this presentation after the event ends, and we also will let you know about rebroadcast if you're interested, or if you have colleagues who weren't able to be on the call today but would like to listen in. Thank you.